Topic examines country risk, which refers to the possibility that political, economic, financial, or social conditions within a country may negatively affect investments, business operations, or cross-border financial transactions. Country risk is particularly important for multinational corporations, banks, and investors operating internationally because changes in government policy, economic instability, or geopolitical tensions can significantly influence asset values and repayment capacity. The topic explains that country risk encompasses several components, including political risk, transfer risk, exchange rate risk, legal risk, and macroeconomic instability. Effective assessment of country risk is essential because global financial markets are increasingly interconnected, causing domestic disruptions to generate substantial international financial consequences. The topic emphasizes that political conditions are major drivers of country risk. Government instability, corruption, policy uncertainty, civil unrest, and geopolitical conflict can disrupt economic activity and undermine investor confidence. Political decisions may directly affect foreign investors through taxation changes, capital controls, expropriation, or restrictions on profit repatriation. Transfer risk arises when governments limit the movement of capital or foreign currency, preventing borrowers from meeting obligations denominated in foreign currencies. Exchange rate volatility can also increase repayment burdens for governments and corporations with significant external debt exposure. Consequently, investors and financial institutions closely monitor political developments and policy environments when evaluating international creditworthiness and investment opportunities. Economic factors also play a critical role in determining country risk levels. Countries with weak economic growth, high inflation, excessive external debt, or persistent fiscal deficits are generally considered more vulnerable to financial instability. Current account imbalances, declining foreign exchange reserves, and dependence on commodity exports can further increase susceptibility to external shocks. The topic explains that macroeconomic instability often leads to declining investor confidence, capital outflows, and rising borrowing costs. Financial crises may emerge when governments struggle to maintain currency stability or service debt obligations. Therefore, country risk analysis frequently incorporates indicators such as GDP growth, inflation rates, fiscal balances, reserve adequacy, and debt sustainability metrics. Topic focuses specifically on sovereign default risk, which represents the possibility that a government will fail to meet its debt obligations fully or on time. Sovereign defaults can occur through missed interest payments, delayed principal repayments, forced restructuring, or currency redenomination. Unlike corporate defaults, sovereign defaults involve unique political and economic considerations because governments possess taxation authority and control over monetary policy. However, excessive debt burdens, weak economic conditions, and declining investor confidence can still impair a government's ability to repay creditors. Sovereign risk is critically important because government debt serves as a benchmark for financial markets and influences borrowing conditions across the entire domestic economy. The topic further explains that sovereign default risk is influenced by both willingness and ability to repay debt. Governments may possess sufficient resources but choose not to repay due to political priorities or social pressures. Debt sustainability analysis therefore examines fiscal deficits, debt to GDP ratios, interest payment burdens, and long-term economic growth prospects. External debt denominated in foreign currencies creates additional vulnerabilities because governments cannot easily generate foreign currency through domestic monetary expansion. Credit rating agencies, international organizations, and market participants monitor sovereign bond spreads, credit default swap prices, and macroeconomic indicators to assess changing default probabilities. Financial crises often demonstrate how quickly sovereign credit conditions can deteriorate when investor confidence weakens significantly. The topic concludes by emphasizing the importance of integrating country risk and sovereign risk analysis into broader financial risk management frameworks. International investors and lenders must evaluate not only individual borrower characteristics but also the broader political and macroeconomic environment affecting repayment capacity. Country risk can influence currency stability, capital flows, banking sector performance, and sovereign creditworthiness simultaneously. Because sovereign defaults frequently create spillover effects across domestic and international financial systems, effective monitoring is essential for preserving portfolio stability and managing systemic risk exposures. By combining political analysis, macroeconomic assessment, market indicators, and stress testing, institutions can better anticipate potential disruptions and make more informed cross-border investment and lending decisions.